Okay, so here's the dream. You buy a shopping mall. You take that giant building, pack it full of stores, and sit back while dozens of tenants mail you a rent check every single month. Thousands of people strolling past those shops all day, and each shop hands you money just for the right to exist in your hallway. Feels effortless. It is not effortless. And the truth about how these places actually earn a profit and how they quietly rot from the inside is one of the weirdest tales in the entire property world. Before you see a penny of profit, you have to survive owning the thing in the first place. A full-size regional mall is not a casual buy. Putting one up on bare dirt, with the acres of parking, the plumbing, the wiring, the heating and cooling that has to blanket an entire building, and the endless stack of permits, can burn through hundreds of millions of dollars before one shop ever unlocks its gate. The dirt by itself can run tens of millions. Then comes the concrete, the steel frame, miles of cable and ductwork, multiple parking decks, and a pile of local codes you have to satisfy inch by inch. By the time somebody cuts the ceremonial ribbon, you may have spent more than it costs to build a hospital. Buying one that already exists is usually cheaper on day one. But that's exactly where it gets strange, because no two malls are really the same animal. There's a giant divide in this business between what insiders call Class A malls and everything sitting below them. Class A mall has the fancy department store, huge sales for every square foot of floor, brands lining up on a waiting list to get inside, and rich neighborhoods parked right next door. The best of those change hands for staggering money, sometimes over $1 billion for a single property, because the income is steady and easy to predict. Right now, the strongest of these are pulling sales well above $1,000 per square foot, and a few elite ones are clearing $1,500. Then you've got the malls a couple rungs down. Older bones, weaker anchors, softer neighborhoods around them. Some have sold for pocket change compared to what they cost to build. There's a mall in Akron, Ohio, Rolling Acres, that had been worth well over $30 million, and years later it was changing hands for under $2 million and still bleeding tenants after that. So here's the first thing the daydream leaves out. You are not buying a building. You are buying a wager on a neighborhood, and the price tag basically tells you which wager you just made. By the way, most people who own malls today don't own them the way you own a house. They own a slice of them through something called a real estate investment trust, a REIT. A REIT is a company that holds income-producing property and is legally forced to hand almost all its profit to shareholders every year, and in return it skips corporate income tax on that money. That single rule is a huge reason large-scale mall ownership looks the way it does. A regular person can buy a share of a mall-owning REIT on the stock market for the cost of a sandwich, and never once have to deal with a leaking roof or a dying anchor. The biggest of these companies hold dozens, sometimes over 100 properties at once, so the failure of any one mall gets absorbed across a much larger pile. That's a completely different game from the solo buyer who dumps everything into one building in one town. Say you've picked your mall and the price feels fair. Before a single rent check lands, there's a layer of cost that blindsides almost every first-time owner. First, the anchor leases you inherit, and you don't get to rewrite most of them anytime soon. Those big department stores at the ends of the mall often sign deals decades back, sometimes for absurdly cheap rent, and those contracts can stretch on for years before you can touch the number. You're stuck with whatever the last owner agreed to, brilliant or terrible. Second, deferred maintenance. Roofs fail. The heating and cooling systems keeping 1 million+ square feet comfortable eventually die. Lots crack, escalators and elevators need endless servicing. If the previous owner was quietly skipping repairs to make the books look pretty, you discover it your first winter, usually as one enormous invoice. Third, there are these things called co-tenancy clauses tucked into nearly every mall lease. Put simply, they say that if a major anchor shuts down, the smaller shops nearby are allowed to slash their rent, or in some cases just tear up their lease and walk. You never see that cost on closing day. You see it the day your anchor packs up, and suddenly a dozen other tenants have the legal right to pay you less, or nothing. That's the trapdoor hidden under the floor. On paper, the mall looks packed the day you sign. But the second one big piece pops out, the whole money structure underneath can lurch without you touching a thing. Now here's where it gets interesting, because a mall makes money in more ways than most folks ever imagine. The first and plainest layer is base rent. Every store pays a set monthly amount, usually priced per square foot per year. A little specialty shop in a healthy mall might pay somewhere in the range of $40 to $60 per square foot annually. A giant anchor? Often a sliver of that. In fact, analysts who dug into Sears leases before the company went under found Sears frequently paying somewhere around $5 per square foot, while other tenants in top malls were closer to 50 or 60. Sit with that. The store with the biggest sign and the most floor was paying roughly a tenth per square foot of what the tiny clothing shop beside it paid. Why would any owner sign off on that? Because the anchor isn't paying for space, it's paying with its name. The anchor drags customers through the doors, and those customers drift past a wall of smaller shops on the way in and out. The owner isn't leasing square footage to the anchor. The owner is buying foot traffic from the anchor, and the payment is a discount on rent. Every other store in the building is, in a quiet way, covering that discount, because they're the ones paying full freight to sit close to it. The second layer is percentage rent. This is extra cash on top of base rent, tied straight to how much a store actually sells. It works like this. A shop pays its base rent, but if yearly sales climb past a set figure, called the breakpoint, the mall takes a small cut of everything sold above that mark. So if a store's breakpoint is $1.5 million a year and it rings up $2 million, the mall might scoop up 6 or 7% of that extra $500,000. That's real money that grows on its own as the store thrives, without the owner doing a thing. The third layer is common area maintenance, or CAM. This one's separate from rent. It's the tenants chipping in for the cost of running the building itself, mopping the floors, lighting the corridors, keeping the lot paved, paying security, keeping the escalators alive. Each store pays a portion based on how much space it takes up versus the whole mall. If a year of shared costs adds up to $250,000, and a tenant fills 10% of the mall's leasable space, that tenant owes $25,000 of it. This matters, because it means a big chunk of what it costs to physically run the place isn't paid by the owner at all. It's billed right back to the shops. Then there's a fourth bucket almost nobody pictures. Everything that isn't a store. Parking fees in packed city malls. Ad space on the digital screens and the directory boards. Kiosks planted in the middle of the walkway, which often charge shockingly high rent per square foot, because they take up almost nothing and sit exactly where the crowd is thickest. Pop-up shops, holiday markets, seasonal photo setups. None of this lives in most people's mental image of owning a mall, but for some properties it stacks up to a real slice of the total. And there's a backwards little truth hiding in that kiosk math. A cart in the middle of a busy corridor might cover less than 100 square feet. Yet because it stands right in the river of every shopper flowing through, it can be priced far higher per square foot than a full store along the wall. Size and rent are not the same thing in this business. Position beats space. A tiny stand selling phone cases at the busiest crossroads of the mall can be, foot for foot, the most valuable real estate in the whole building. So far, this sounds like a machine printing cash from 4 directions at once. Now flip the page. Utilities on a building this size are brutal. Keeping 1 million+ square feet heated, cooled, and lit year-round is one of the fattest recurring bills an owner faces. Pile on security payroll, cleaning contracts, landscaping, snow plowing in colder states, and a steady drip of small repairs. A busted sprinkler here, a shattered tile there. And the monthly operating cost of a big mall can climb into the hundreds of thousands before $1 even touches the loan used to buy it. Then property tax, which on a large commercial site in a major metro, can be one of the single biggest line items all year. And insurance, which has been shooting up across all of commercial real estate lately, especially on older buildings. There's also a nasty detail tucked inside that CAM system. Those shared costs don't shrink just because part of the mall sits dark. The corridors still get cleaned whether the shops beside them are open or not. The lights above an empty storefront still draw power. Security still has to patrol the whole place, not just the rented parts. So when vacancy climbs, that same fixed pile of shared expense gets split among fewer paying tenants, which means each surviving tenant's CAM bill goes up, even though nothing about the building's actual upkeep changed. Rising vacancy doesn't only mean lost rent from the empty units. It quietly raises the cost of staying in business for every shop still hanging on. And that's exactly the pressure that shoves the weakest ones out the door too. Here's the trap nobody spots until they already own the place. Even a mostly full mall can lose money if the mix is wrong. This is the part that flips your intuition. It's not just how many stores are open, it's who's paying real rent and who isn't. A mall can read 90% occupied and look perfectly healthy from the outside. But if half that filled space is anchors paying almost nothing, and a growing chunk of the smaller shops are on short, cheap leases just to keep the lights on, the actual cash coming in can be far weaker than the occupancy number suggests. Occupancy is not the same as income. That one gap is where a lot of owners quietly walk off a cliff. Before we get to how malls actually die, it's worth understanding something the developers figured out generations ago, because it explains almost the entire shape of these buildings. The man most credited with inventing the modern American mall was a Michigan developer named Alfred Taubman. He didn't just throw up shopping centers. He obsessed over how people physically move through a space, then bent the building around that movement. He set the anchor stores far apart from each other, roughly the length of about 3 city blocks, so anyone walking from one big store to the other had to pass a gauntlet of smaller shops. He parked the escalators and elevators at the ends of the halls instead of the center, so people would walk a full corridor to reach them. He mixed skylights with artificial light so shoppers couldn't quite tell how much of the day had slipped by. None of it was decoration. Every single choice existed to stretch the amount of storefront a shopper's eyes would slide across before reaching whatever they came in for. That's the whole commercial engine of a mall in one line. Force people to move, and you increase exposure. And exposure is the actual product the smaller tenants are buying when they sign. Now here's the structural danger threading through this entire business, and it's clearest through something that really happened all across the American mall industry. For most of the last century, the department stores, Sears above all, were the spine of the mall. They were the reason malls got built at all. Developers often wouldn't even break ground until they had 1 or 2 big department stores locked in as anchors, because the banks wouldn't lend a dime without that promise of foot traffic. But starting in the 2000s, and speeding up hard after 2010, those same department stores began going dark at a frightening pace. Sears, once the biggest retailer in the whole country, with roughly 4,000 stores at its peak, filed for bankruptcy protection in October of 2018. At that moment, one major mall owner had Sears sitting inside dozens of its properties. Another had it in dozens more. Across the industry, the overwhelming share of Sears stores lived inside regional malls. Here's why that mattered so much more than any ordinary closure. Remember those co-tenancy clauses? When an anchor goes dark, the smaller tenants around it can legally cut their rent or bail on their lease. So one closure doesn't just erase one tenant's check. It can set off a chain of rent cuts across the whole mall, sometimes hitting dozens of shops at once. All because of contract language written years earlier, back when everyone assumed the anchor would stand there forever. And refilling that empty anchor box is not quick or cheap. These buildings were built for one very specific kind of tenant: enormous open floors, sometimes over 100,000 square feet, with loading docks and layouts that don't slide easily into anything else. One mall owner spent something like $100 million over 3 years just to chop a single old department store into a handful of smaller ones. Multiply that price and that timeline across dozens of empty anchor boxes at the same moment, which is exactly what happened as Sears shut hundreds of stores at once, and you start to see why analysts warned the bankruptcy would hurt mall owners for years, not months. This is the structural truth under the whole industry. A mall doesn't collapse because business is bad everywhere. It collapses because one piece slides out, and the rest was quietly built to lean on that piece staying put. To watch this play out for real, it helps to follow one actual mall from grand opening to wrecking ball. Rolling Acres Mall opened in Akron in August of 1975, the only 2-story mall in the county at the time, starting with around 20 stores. Within a few years, it ballooned to well over 100 shops, multiple department store anchors, a movie theater, a food court. By the mid-90s, it was one of the busiest shopping spots in the region, and when a new Target arrived, the place was reported to be running near 98% full. Then, slowly, the anchors started peeling off. A newer, freshly renovated rival mall opened nearby in the late 90s and siphoned off the crowds. Target hopped to a different town. Other department stores closed or got rebranded and then shut down anyway on weak sales. By the mid-2000s, occupancy had cratered, and the mall, once valued at well over $30 million, sold for under $2 million. The interior officially closed in 2008, though a couple of anchors clung on through their own outside doors for a while. Sears finally closed in 2011. The last tenant hung on until the very end of 2013, and after that the building sat completely dead. What came next is why this belongs on a finance channel, and not a ghost story channel. The empty shell drew scrappers who ripped out copper wiring and anything else worth money. One man died after being electrocuted trying to steal copper from an electrical box on the property. Vandals smashed the skylights, and for years rain and snow poured straight into the building, rotting the floors and ceilings from within. The city of Akron eventually had to seize the property itself, because the owners had simply stopped paying the property taxes, running up over $1 million in unpaid bills before the city stepped in. The building was finally torn down in stages, and Amazon later put a distribution center on the same ground. Hold on to this if you ever think a full mall is a safe mall. Rolling Acres was near 98% occupied at its peak. It took less than 2 decades to go from that number to a pile of rubble in a warehouse. And the line between those two states wasn't one dramatic disaster. It was a string of smaller ones, each making the next a little more likely. The Sears bankruptcy and the slow death of malls like Rolling Acres didn't happen in a vacuum. They happened right as online shopping was swallowing a bigger and bigger share of retail spending. For most of the last century, a mall's real product wasn't the stores inside it. It was convenience. If you wanted to compare 5 brands of sneakers in one afternoon, the mall was the only place in town that let you do it in one trip. That convenience was the whole reason people drove across town and paid to park. Online shopping shattered that monopoly completely. Now a shopper can compare hundreds of options from the couch, get it dropped at the door in a day or two, and never touch a parking lot, a walk, or a checkout line. The mall's original reason to exist, convenience, simply stopped being unique to malls. That's why the malls that struggled hardest were usually the ones stuck in the middle. Not fancy enough to sell an experience you couldn't get online, but not cheap enough to win on price against the discounters either. The weakest ones, already strained, or sitting in areas losing population, got hit first and hit hardest. The strong malls kept getting stronger, and the weak ones kept getting weaker. The owners who kept their properties breathing did it by changing what they were selling. Instead of stuffing the place with more clothing shops, many started filling their dead anchor boxes with things a screen genuinely can't replace. Restaurants that need a physical table, gyms and fitness studios, medical clinics and urgent care, which have to have a location by definition, co-working offices, entertainment, theaters, arcades, indoor attractions. Some malls turned whole wings into apartments or hotels, converting pure retail into a mixed-use property with several income streams instead of just one. The idea is simple, even if pulling it off is slow and expensive. A mall used to sell products. The ones that survived started selling reasons to physically leave the house, reasons the internet can't deliver to your door. So does owning a shopping mall actually work as a business? The honest answer depends entirely on which mall, and the gap between the good ending and the bad ending is enormous. In the sunny version, you own a well-placed mall with strong anchors still pulling heavy foot traffic, a healthy blend of restaurants and services alongside the stores, and low vacancy. In that case, base rent, percentage rent from busy tenants, and CAM reimbursements combine into steady, predictable income month after month, with property values holding or even rising as the neighborhood keeps growing. That's the outcome that turned the biggest mall companies into some of the largest real estate businesses on the stock market, and turned men like Alfred Taubman into billionaires. In the realistic bad year version, one major anchor closes. Co-tenancy clauses fire. A handful of smaller tenants renegotiate their rent down, and a few more just leave when their leases expire. Utilities, insurance, and property taxes keep climbing no matter how many stores are open, because those bills track the size of the building, not its occupancy. Meanwhile, the empty anchor box sits there for a year, 2 years, sometimes far longer, earning nothing while still needing to be secured, insured, and maintained. On top of that, the fixed CAM pool now spreads across fewer paying tenants, so even the loyal ones quietly pay more just to keep the lights on in hallways that see fewer people every month. The difference between those 2 years, for the very same building, is the difference between a growing asset and one drifting toward the same ending as Rolling Acres. Neither one is exotic or theoretical. Both happen constantly across this industry, sometimes to the same building barely a decade apart. Rolling Acres itself lived the sunny version first. Nearly full, multiple anchors, over 100 stores, a genuine local landmark, before sliding into the bad version and never climbing back out. The building didn't change. The economics underneath it did. From the outside, a mall looks like a building full of stores. From the inside, it's really a single, tightly wired financial system, where every tenant's fate is quietly bolted to every other tenant's fate, whether any of them realize it or not. The anchor doesn't just sell appliances or clothes. It sells the foot traffic that every smaller shop around it depends on to survive. And when it leaves, it doesn't just punch a hole in the floor plan, it yanks the financial floor out from under everyone standing nearby. The building was never really the business. The people walking through it were.